good morning to all of you. Hope everyone's staying safe. I will start off by just posting up the agenda for today. These are the things that we're going to cover. We won't necessarily go through every slide, but what we intend to share with you is how we have been navigating through the current environment over the past couple of months, and what we're doing currently and how we see things in the nearer term. Before I start on the slides proper, just by way of a summary and introduction, what we are witnessing currently, as most of you are aware and appreciate, is a tale of two extremes. On the one hand, we're clearly seeing severe implications on the global economy because of COVID-19 and the resultant lockdowns that we have seen being implemented across many countries around the world. So this sudden shutdown that we're seeing in the economies will definitely have an effect on global growth, on corporate profits. So that's one extreme. On the opposite side, we have the other extreme where we're seeing central banks around the world, governments around the world, embarking on unprecedented levels of stimulus to stabilize the economy. And it's currently a tug of war between what the governments and policymakers are doing versus how the real economy is behaving currently. And at the moment, it seems like the policymakers are winning because markets have rebounded, but it remains to be seen. Things will continue to remain choppy and volatile. And a lot of this depends on how long COVID-19 lasts. So that's just by way of introduction. And also I'd like to share with you, before I move into the slides, our strategy so far in navigating this period. As we first started to see an escalation of COVID-19 cases outside of China, we made the decision to be more defensive in our investments. We raised a lot of cash for our portfolios because we were concerned as to the speed and pace of how these infections are occurring around the world. And we managed to defend the portfolios better because of having high levels of cash. But over the last 3 or 4 weeks, given that the markets had corrected so sharply and looking at what the governments have been doing and central banks have been doing, we have been gradually deploying monies back into the market. As it stands currently, we're still sitting on comfortable levels of cash. It's just that we have put some money back to work in certain specific ideas and at certain valuations. But at this point in time, given the high level of uncertainty that we are experiencing, I think it's still prudent, being custodians of your monies, for us to sit on a slightly higher level of cash than we would normally be sitting on. So that's just by way of introduction. Now, if we can move to the slides. Okay, this is just an asset class quilt of returns. It's just to share with you all the returns of the various asset classes year to date. The rightmost column, you can see the best performing asset class in a period such as this, when there's crisis, when there's a lot of policy stimulus, has been gold. The other asset class that has done well year to date has been US Treasuries or US government bonds. Now, the point of this slide is really not to talk so much about the current situation, but just to emphasize again what we've always been emphasizing, and is that it is very hard to always pick the winner and to avoid the loser in any particular year. Therefore, what we've always advocated to our investors and our clients is to have a diversified portfolio. And when we talk about diversification, do not take it to the extreme and diversify into everything under the sun, but really have a view, consult with your advisors, and have a view about how the world is going to be in the nearer term or in the medium term, and have a strategic allocation to various asset classes and to various geographies. Because as you can see from this slide, different asset classes, different regions perform differently during different periods and in different years. So that's the main key takeaway that I would like you all to gather from this particular slide. Now let's move on to the current situation. As you know, it's absolutely challenging. It's very volatile. You're going to hear the word volatility from me and my colleagues throughout this presentation. And all presentations that you're going to hear from fund managers, they're going to quote the word volatile and unprecedented. Now, how we're trying to navigate and handicap ourselves through this is just using a fairly simple framework just to help us frame our thoughts. What we're looking at is the 4P's. The first P is policies, second P is profits, third P is positioning, and fourth P obviously is pandemic or COVID-19. And these are guideposts that we're using to help guide our decision making as far as investing in the market is concerned. Okay, move on to the next slide on the first P. There is a saying in investments that when policymakers panic, the market stop panicking. And most of the time, it is quite true. It doesn't mean that the market makes an absolute bottom, but most of the time, it leads to some form of at least near-term stabilization of the market. And this time around, as we saw COVID-19 cases start to escalate around the world, as we started to see both stock and bond markets correct quite sharply, we then saw policymakers around the world start to panic. And since towards the end of March, middle and end of March, they have been doing whatever they can to try to stabilize the financial markets as well as to stabilize the underlying economy. So on this slide, you can see just some examples. Number one, if you look at the chart on the left, you can see central banks around the world have embarked on QE or liquidity injections into the system through various methods. I won't go into the detail. There are further slides which you can read later on the details. But suffice to say that the amount of central bank purchases that we're witnessing today is a lot larger than what we've seen in our lifetimes. Even during the global financial crisis, when QE was first initiated, the levels that we're experiencing, that we're witnessing today, is a lot more than what we've seen in the past. That is on monetary stimulus. If you look on the same page on the right, in addition to monetary stimulus, which is implemented by central banks, we are also witnessing unprecedented levels of fiscal stimulus. Fiscal stimulus is simply the amount of stimulus that is executed or implemented by governments. And this is not just a US-centric or Japan-centric development. It is what we are witnessing across all major economies. Even in Malaysia, in Australia, governments have no choice but to spend to help stabilize the underlying economies during this period. You can see on this chart, the chart on the right, the deficit of the G4 countries plus China is about 6.9% of GDP. This is higher than what we saw during the global financial crisis in 2009. But I suspect before this is over, the 6.9% figure would be quite a lot larger as governments would need to continue to spend to support the economy. Moving on to the next slide. These are some of the examples of policy measures that have been announced by the Federal Reserve. I think while we can sit here and each of us may have differing views as to the morality or ethics of central bankers doing what they're doing, we have to deal with what we're currently facing. It is what it is. And given the situation, I think the central bankers have no choice but to embark on unconventional measures to help stabilize the financial markets. So these are some of the things that they've done over the past few weeks. Even recently up in April, what they did was commendable, rightly or wrongly, but given the current environment, this was necessary because there was extreme dislocation in the financial markets, especially in the fixed income and the credit markets. And at the risk of repeating myself, why do we focus so much on the credit and fixed income markets? It is because asset classes all around the world are priced off the fixed income markets, especially the US Treasury market. So if you have dislocation and complete mispricing in the credit and fixed income markets, then it leads to dislocation in other asset classes all around the world. So in that sense, I think the Fed got it right. At one point, we saw very extreme bid and ask spreads, even in US Treasuries, what more in investment grade and high yield bonds. We saw forced selling, there was no one bidding. Therefore, the Federal Reserve had no choice but to step in, and some of these measures which they have announced has led to a return of some normality in the fixed income and credit markets. So much so that in the last 3 to 4 weeks, and Philip, my colleague who looks at fixed income, he can perhaps share more color later. So much so that in the last 3 to 4 weeks, we have seen a resumption of new bond issuances in the investment grade markets initially, and subsequently even in the high yield bond market. And the reception or the demand for some of these bonds have been tremendous. They have been very hot. So in a way that is good. There is a return of normality. So that's a positive. Can just move on to the next slide. As a result of this unleashing of bazookas and monetary policies, we are also witnessing an expansion of balance sheets all around the world. Again, different people have different views, but most of the time, there is a saying that you don't fight the Fed, the Federal Reserve. If the Federal Reserve is on the other side, giving you a put option, and they are expanding their balance sheets and injecting so much liquidity into the market, you do not want to be overly bearish, because with liquidity, I always use this analogy, money always has to find a home. And while the real economy may continue to struggle, this excess amount of monies will find a home typically in financial assets, which is why we've seen this very sharp recovery in stock markets, as well as in some segments of the fixed income markets. So this slide here shows you money supply as well as the Fed balance sheet. Money supply very clearly, the bottom chart, the green dotted line, money supply is expanding at a rapid pace. And while I caution against relying totally on history, because there's a saying, history does not necessarily repeat itself, but history usually rhymes. If history does repeat itself, though, this sharp expansion in money supply that we're seeing in the US should lead to, if not a sharp recovery in the stock market, at least some stabilization in the stock market. But stranger things have happened. So that's this slide. If you can just move on to the next slide, which I won't run through in detail, but suffice to say, central banks in other parts of the world are also embarking on their stimulus measures, their policy measures. Europe, EU, the UK, Japan, all doing similar things. So that's on the first point, the first factor. Remember at the start, I talked about the 4P's on policies, which is the first factor. I would rate it as a positive. I would give it a check or a tick, and that has definitely helped to stabilize markets and lead to a very sharp rebound in stock markets, as well as in some segments of the fixed income market. Now, if we can move on to the second P, which is profits. In trying to handicap profits, unfortunately, there's completely no visibility. It is not just us from a fund manager's perspective or from an analyst perspective. Even companies themselves, and most of you here would know people who are businessmen or operate in various businesses. You would agree with me that there is no visibility, because we don't know how long this lockdown is going to last. We're also uncertain how consumers would behave and businesses would behave even after lockdowns are lifted. Only thing I want to highlight here is we know that corporate profits, economic GDP would be bad, would be negative. We will enter into recessions. Question is how long. We know that corporate profits would have to be revised downwards. These two charts show you earnings expectations for Asia as well as the US S&P 500. You can see the trajectory is down, right? This will not come as a surprise to all of us. And I suspect that the downgrades or negative revisions are not over. Analysts and strategists would have to continue to revise their expectations lower the longer the lockdown extends. However, I want to again remind you not to be overly bearish, given what I've just said, because remember, we have ample liquidity given what policymakers are doing. At the same time, you must always remember that stock markets and financial markets are forward-looking. If the market sniffs out that, look, this deterioration in earnings or this recession that we are entering is only going to be short or brief, then the markets may not correct much. Okay? So bear that in mind whenever you make your investment decisions. So that's on profits. Well, we know that the trend is going to be poor in the near term. A lot of people are thinking, look, let's just forget about 2020. If a drug or vaccine can be found, a drug can be found in the next few months, and then subsequently in 12 to 18 months, a vaccine can be found. Then let's focus on 2021, 2022, when things should be getting back closer to normal. So there's still a lot of moving parts as far as developments on drugs and vaccines is concerned. But if that's the view we're taking and you believe in human invention and ingenuity, then if you have a longer term time frame, then yes, this is a time to start getting dipping your toes back into the markets. But in the nearer term, profits, as I said, is going to be negative. There's a lack of visibility. And therefore, on the factor of profit, we are unable to give it a check. We are unable to give it a passing grade. Now, moving on to the third factor, the third P, which is positioning. In helping us guide our nearer term decision making as far as investing is concerned, we also like to look at sentiment and positioning. So these are just examples of some of the things we track. One of this is what we call the bull-bear indicator, which is the green and red chart you can see on your screen. Now, clearly, sentiment is extremely bearish. I think you speak to a lot of people out on the street, you speak to investors generally, they are very bearish because you read the headlines, you read about infections, you read about lockdowns. The tendency, of course, is to be bearish. But sometimes when everyone else is so bearish, it pays to be a little bit contrarian. And given that we've seen this extreme bearishness in markets, a few weeks ago, we started to take a little bit of a contrarian approach to deploy its money back into the market. Now, nothing is ever absolute. Just to share with you examples, during the global financial crisis, this indicator also declined to zero, which is extreme bearishness, but it stayed at zero for over 200 days. So just because it's gone to extreme bearish doesn't mean it cannot stay extremely bearish for a long time. And it also does not mean that markets cannot, after this rally, cannot correct to lower levels, right? So for us as fund managers, during this period, we have to be dynamic as well. While personally, I think that what we saw at the end of March is probably the low for this period. We do not discount that if there's a second wave of the pandemic, and lockdowns have to be extended, we will have to revise our views. And in this current period, I think it is crucial for us as fund managers not to be overly stubborn, to really keep an eye very closely on what's happening on the ground in terms of COVID-19 developments. Be that as it may, currently and in the past few weeks, given this extreme bearish sentiment, tactically, at least in the shorter term, we made that call to put money back into the market. The other thing we look at on the next slide in guiding us on positioning is to look at fund flows. You can see on this table, initially we saw very large outflows from emerging markets. The top line of the table, you can see from 12 February to 25th February 2020, during a 6-week period, we saw about $31 billion of outflows from emerging markets. which is why we saw that 25% decline in stock markets or emerging market indices. Right. So again, having seen this and looking at how markets had behaved in previous crises, it was a judgment call on our part to deploy some money back to work in the market. And since 25th of March, you can see at the bottom of this chart of this slide, we have actually seen a resumption, not a lot, but a little bit of inflows back into emerging markets. So that's on positioning, which is the third factor we're trying to handicap. Positioning at this point, I would say it's a little bit more neutral because the extreme sell-off, the extreme outflows had already happened. So 3-4 weeks ago, as I said, we put some money back into the market. Currently, we would adopt a more neutral view and await further developments on corporate profits and corporate announcements, as well as on COVID-19. But 3-4 weeks ago, we would have rated positioning a 1. We would have given it a pass grade, and that would have guided our investment decision making. Now, moving on to the next slide, which is the 4th P, pandemic. This is where there's a lack of certainty because there are a lot of things we don't know. We don't know a lot of things as far as the virus is concerned, and the experts are still coming to terms with it. But in the near term, what we've seen in the past few weeks, a lot of investors' focus was on a peaking of infection rates. Investors were prepared to give the benefit of the doubt to markets if they can forecast with a high level of probability when the peak infection rates of the various countries would occur. So on this slide, you can see, of course, China was the first into this. They are on the recovery side, recovery path. Korea as well is on the path to recovery. There is, of course, the risk of a second wave, but so far, both countries seem to have it under control. And on this chart as well, whether you believe it or not, Malaysia is also gone beyond the peak. It is now close on the path to recovery. Of course, crucially for financial markets, it would be the US. And the US as well is a large country. So where we actually spend a lot of our focus on is looking at what's happening in places like California and New York. And in New York, the data points that we're tracking shows that the number of infections are declining, number of hospitalizations and ICU admissions are also declining, effectively moving in the right direction. So that also lends some support to financial markets. Now, I emphasized earlier that in the shorter term, this is what investors are looking at. Beyond this, of course, we have to focus on drugs, vaccine, and the extent of economic lockdowns, and more crucially, whether there's going to be a second wave. Now, for the US as well, one of the things that they need to improve on the next slide, is really their testing rate, because currently the number of tests that they are administering is still a little bit too low for our comfort, given the size of the population in the US. And there is a lack of supplies at the moment, but from what we gather, once supplies of testing kits can be found, the testing rate would increase, and that should also lead to a lower positive rate. And while this is most crucial for the US, given that US is the biggest financial market in the world, this applies as well to all countries that are suffering from COVID-19. Moving on to the next slide, what I mentioned earlier, the key, of course, US, there are a lot of different states in the US, but for us, the areas that we are focusing on most closely is on New York, which is the epicenter of the US. And you can see on this slide here that the developments in New York are encouraging. Now, moving on to the next slide, which is China. China appears to have things under control. Domestically, the transmission is already very low and very low single digits. So far, the new cases that we've been tracking shows that majority of the cases are imported. And as a result of that and China's fear of a second wave, they have implemented travel restrictions on people coming back into China. And if that continues, then they should have things under control. Now, given that China is the first country that got into COVID-19 and has now on the path to recovery, I think China's experience would be crucial in how other countries would behave. And on this point, moving on to the next slide, this was one of the key factors which led us to redeploy money back into China, especially into China domestic names, domestic orientated companies, because we do track industrial activities in China, and you can see from this map here that activities in China are gradually picking up. Although utilization rates in the factories may not be back to normal, in fact, far from normal, but the fact is activities are picking up, both in terms of industrial activity, but we are also tracking consumer activity. Consumer behavior is also improving. So if they can get COVID-19 under control, this would get them closer and closer to normalization. And finally, on the pandemic, if you can find a vaccine cure tomorrow, then very quickly markets would go back to normal. But we all know that vaccines take anywhere between 12 to 18 months before it can be approved. Given the number of labs and experts that are looking at coming up with a vaccine, perhaps it can be quicker. But you know, there is a process, phase 1, phase 2, phase 3 trials, in order to render a vaccine safe for mass consumption. So give it 12 to 18 months before we can see a vaccine. So a vaccine is not a solution in the nearer term. What are the possible factors that could lead to a return to normalization in the nearer term, or some form of normalization in the nearer term? Is number one, testing. If we can get a lot of test kits out into the markets, into all countries around the world, so that we can see who is positive, who is negative, who's got the antibodies, then people would be a little bit braver to go back to their daily lifestyles or activities, or at least closer to their normal daily lifestyle activities. The second point would be on drugs. These are what we call repurposed drugs. There are two which are showing promise. The first one is remdesivir by Gilead in the US, and the second one is a Japanese drug called favipiravir. And both are showing some promise, although we still need further confirmation on the trials that are currently being done on these two tests. But if they do come out and show encouraging signs that they are able to treat COVID-19 patients effectively, then that will be a positive for governments and markets around the world, because it means that governments would then be more comfortable in reopening their economies. And that will be good for businesses and consumers. And the third point is vaccines. I'll just leave it there for you to read, but vaccines will take a while. So moving on to the final slide from me, the impact from COVID-19, a lot of it remains uncertain, because we don't know how long this would stay with us. But at the moment, as I said right from the start, it is a tug of war between stimulus, unprecedented stimulus, and the unprecedented effects of the economic lockdowns that we are witnessing. At this point in time, stimulus seems to be winning, but things can change very quickly. So in conclusion, from my side, these are the key takeaways and messages I'd like to share. The Federal Reserve, Central Bank, and government around the world are basically offering put options at this point. They are doing whatever they can to ensure that the world does not go into a depression. A recession is a given, but reminder again, financial markets look ahead. For us as fund managers managing your monies, we have to be judicious in how we manage your monies. I think given our experience of various crises, and no crisis is ever the same, but generally they kind of rhyme. Given our past experience, the most important thing for us as fund managers and for you as investors is to make sure we come out of this alive. So coming out of this alive means what? Number one, have some cash. For us managing your funds, we are also keeping some cash. For you, your decision making cannot be as quick as ours. So for you, it's always being mindful of your more strategic asset allocation. And for those of us who are prepared to take some risk, I think it is okay to put some monies back to work in the market, but do not go all in. It's best to scale in. The third takeaway, just to share with you some of our thoughts, what we've been investing in. Few things we like. We've always liked long-term themes, companies that can grow over the long term. regardless of the macroeconomic environment. During this year, perhaps their growth rates may slow down, but over a multi-year period, there are companies out there who will continue to grow by virtue of the fact that they are operating in businesses where demand or technological disruptions require their software or their business. We also have been investing in some of cyclical ideas. As I mentioned, China, given that things are normalizing in China, we have invested in some consumer names in China, some building materials and property names in China because of a resumption of activities. Final point I'd like to share with you is we will continue to be nimble and tactical. We are not going to be stubborn. We will be prepared to admit that we are wrong if the markets are showing signs that we are wrong. But at this point in time, we are of the view that the lows that we've seen at the end of March is the lows for this cycle. So we can be nimble, but you as investors, you cannot be as nimble. So reminder again, asset allocation is the key. That ends my part. Thank you.